Welcome everybody. Welcome to Making Money in the Market with VectorVest in the markets there. And let me just transition myself here. So my name is Russell Markham. I'm the Director of Education for VectorVest Australia. My pleasure to have you along today. With that said, let's jump back into the slides here. And what I'm going to do here, just note our license numbers. So we fully licensed there for general advice only. And so with that, I cannot take into account your personal financial circumstances. So please speak to your financial advisor for any personal advice. Past performance is not guaranteed. All right, for future performance, of course. And speak to your financial advisor for any personal tailoring, etc. All right, as long as we're all clear with that, let's get into it. So I'm going to jump out of here. And what I'm going to do here, this is VectorVest United States. I'm going to jump into VectorVest Australia. I've got something very interesting to share with you today. I'm going to go to the Graphs tab in VectorVest, and I'm going to keep it nice and simple to begin with. This is a graph that we refer to in VectorVest as the market climate graph. All right, so we refer to it as the market climate graph. It gives us the big macro overall picture. So you'll see there that Reserve Bank Governor Bullard on yesterday, was it? So as of time recording here, as of yesterday, that being Tuesday, didn't cut the interest rates. Interest rates were kept on hold. And one of the reasons being is that there wasn't enough evidence of inflation coming down. All right, so again, you could drill into all the key notes there, but general theme is that if there's concern that or should I say inflation? There's concern that inflation rates weren't coming down. So if the inflation rate's concerned that it's not coming down fast enough, or there's a concern that it might be going back up again, then the Reserve Bank is less likely to cut interest rates. And so there's that concern around inflation. Well, let's go and have a look at the big macro picture. What drives the economy? What drives the share market? We all know that a falling interest rate there helps drive the economy. So let's put that on to begin with. Let's keep it nice and simple to begin with. So there's two different measures for interest rates, two key ones, T-notes and T-bills. One's a longer one, one's a shorter one. Don't get too hung up on it. It's more the trend that has been taking place. And you can see here, certainly on T-bills in recent times, you can see how interest rates have been coming down. All right, so over the last 2 years, interest rates have been coming down. So if you're on, let's say, a variable-only mortgage, you'd be feeling a lot better than what you were, say, 2 years ago. Your variable mortgage now, I'll just make this jump out a bit more. Your variable mortgage now has probably come down from potentially 6% to 5%, around about 5, maybe 5.2, 5.3, depending on who you're using and what competitive rate you're getting, etc., etc. And you could look at websites like CanStar that will give you, some of the key comparison rates across different providers out there. So good. Falling interest rates drive share markets, right? So whether you're looking at T-notes or T-bills, falling interest rates drive the share market. Another key driver, as we noted before, that's inflation. Falling inflation drives the share market higher, right? Why would falling inflation help drive the market higher? Some economists might argue to say, well, if inflation's falling, it means the economy's not running too well. People are spending less on goods and services, and so therefore, isn't it a slowing economy? Well, compare it from a share investing perspective. Shares are represented by companies effectively, and so falling inflation, CPI, which measures a typical basket of goods and services. And again, there's a whole lot of debate as to what really should go into it. There is some debate as to how accurate it is. There are some economists that will say, well, it's not a true representation. A true representation would be to basically take all goods and services out there and weight them accordingly depending on the demand for them. There's lots of different ways you can measure inflation, but the best we have right now globally is CPI, Consumer Price Index. And so a typical basket of goods and services, we can see that inflation's been falling. And so this is good for a company because companies need typical goods and services to go in to manufacturing, for example. So CPI would incorporate things like changes in key commodity prices. When you have a falling inflation, there's less demand on wages rising typically, because employers, employees sort of have the discussions on what the wage should be. If things keep going up in price, well, then you're going to ask for a pay rise. And if things start getting cheaper and cheaper, perhaps those employing you might say, well, hang on, there isn't such a big requirement anymore. We'll give you a pay increase at 1% above the inflation rate, for example. So anyway, I digress. But falling CPI is good for the share market. And then there's a final really, really important ingredient, earnings. Earnings is the engine room that will drive shares. All right, so you need companies to be making more and more money to help them effectively drive their share prices higher. Okay, and so with that said, you can see over here, earnings. And so what we do at VectorVest is we've got our earnings trend indicator, ETI. It's on a scale of 0 to 2. All right, so an earnings ETI trend above 1 tells us that on average companies are growing their earnings, and an ETI below 1, like what we saw falling here. All right, we saw that back in August 2023. This is not good for companies, right? So companies' earnings are falling away. So I'm going to show you how we put this all together in VectorVest. I'm going to go to one of our essays, and every week we write an essay. You can see here I wrote about this very topic, so that's why I'm presenting on it, because it's so important. And so at the moment, believe it or not, we are in what we call a case 1 bull market. The bull market begins, earnings are rising. So if we come back to here, we see the ETI, earnings are starting to pick up. Good. Coming back to the views here, whoop, I'll scroll down again. All right, inflation. Now, you'll see here on the graph, we noted that CPI was falling. All right, so if I come back here and put in CPI, all right, so here's CPI. We can see CPI is falling, but we don't just simply incorporate CPI. We also incorporate just a few more extra things in here as well. Let's go back to the view, sorry. Scroll down here just a tad. So inflation, we take into account CPI and CRB. All right, so we incorporate those two together. And again, that's a discussion for another time on what CRB incorporates and what it's used for calculating. But between the two here, it gives you a very accurate indication. And so it's quite telling, because we didn't get that interest rate cut on Tuesday, right? We didn't get it yesterday, and it's because the Reserve Bank of Australia is looking at more than just simply CPI. I believe they're also looking at CRB and a few other indicators, and they're going, well, hang on. So incorporating CRB and CPI, we're noting inflation is slightly rising. Now, we put these on a scale of 0 to 2, earnings, inflation, and interest rates. So above 1 means it's favorable. So you see there in green, it's favorable. Green, it's favorable. It's above 1. Red is unfavorable because it's below 1. But the good news is that it's 0.98. So it's sort of neither here nor there. It sort of bobs in between good and bad. And so whether it's rising or falling, it doesn't matter. We still incorporate either a case 1 or case 2 bull market. All right, so you'll see there's been a lot of news narrative out there saying, is Australia about to go into, a recession? Is inflation going to get out of control? Are we going to go into recession? Has the Reserve Bank not cut interest rates fast enough? We're going to go into recession, etc., etc. It's all that narrative behind it, and therefore the share market's going to crash. There's a bit of narrative around that. So what we do here at VectorVest is we don't speculate, we don't do opinion pieces. We are looking purely at the facts. The facts are that earnings are rising, inflation is rising slightly, and we're also seeing interest rates, as we saw in the T-notes and T-bills, is falling. And so therefore, rising earnings, rising inflation, rising interest rates, the bull market begins. Case 2, earnings rising, inflation falling, and interest rates falling, a bull market thrives. So we're on the cusps of either a beginning of a bull market, believe it or not, as good as the market has been this year so far, or a bull market thriving. Now, if you don't believe me, let me go and show you something very interesting. Let's go back to the earnings. We know earnings really helps drive that share market higher. I'm going to show you this for both Australia and for America. So here on the 30th of August, our earnings trend indicator here went above 1.05. Above 1, we note that the overall earnings on the All Ords is going up. So that's a good time to consider being in the share market. So 30th of August 2024. And what I'll do here, I'll go to VectorVest's stock viewer. So I already did it, 30th of August 2024. And what VectorVest will do is it will rank and sort the best combinations of fundamentals and technicals each and every day. Now again, I don't want to sort of information overload you here. So let's just do this, just tidy it up a bit. So this is the company and the symbol. You can do all this wonderful functionality with VectorVest. I just want to keep it nice and simple for us to begin with. All right, so if I were to take the top 30 stocks as of 30th of August, let's pretend we bought them. I'm not saying we're going to do it, but on the 30th of August through to the 30th of September, 30th of August 24 to 30 September 2025, those stocks there return collectively an average return there of 49.95%, when the market on the all odds went up 9.85%. All right, so you can see the top performers up here, some very good ones, 246% for CYL, etc., and you can see one or two laggards down the bottom here. The weighted effect across the 30 there, 49%. If you can time your entry into the market when earnings are rising, when interest rates, whether it be T-bills and T-notes, are falling, and where inflation is coming down, then you're setting yourself up for a very good macro outcome. And then what you do is you'll combine that by making sure that the companies that you buy are companies that are growing their earnings. And so looking at individual stocks here, let's just go back to a VectorVest simple graph here. And so I'll do this. Here's the company. And what you want to do is you want to be buying in as the earnings are rising. Here the earnings start turning, and you can see from here share price starts going up. All right, next one here. Look at the earnings, up and up and up they go. This was one of the best performers. No surprises there. The earnings are going up. And when did we say? 30th of August 2024. So we are 30th of August 2024. Let's get it to the 30th. All right, there we are. That's the 30th of August. Let's just make this jump out just a bit more for you to see. There we are, 30th of August. Earnings are coming up. We know in the economy that interest rates at that point started coming down, and so did inflation. And so you've got all the ingredients. Earnings are going up. The economy is helping you with lower inflation and low interest rates as they start playing out. And so that's why you go from a $2.28 to a $7.90 odd stock. Okay, and away you go. And so you just repeat and rinse. Let's go and show you the same exercise for America. It doesn't matter which country you do, the same theme plays out over and over again. So I'm going to go to graphs, and I've gone to my market climate graph. I'll make this, let's make this an area graph, just make it jump out a bit more so it's nice and easy to see. Here's our earnings trend indicator, ETI. All right, just like we did for Australia, ETI. So dipped over here, this was COVID, then it recovered, the explosive recovery began. So what date was that? 22 January 2021. All right, so just remember that's where the earnings start turning around. The earnings trend indicator on a scale of 0 to 2 above 1, the trend is going up, below 1, earnings are falling. So this is across the S&P index. All right, so we see that. Now, next question we've got to ask ourselves is interest rates coming down. Yep. So not there. At that point it was exploding, but then we started to be assisted at that point. It starts rolling over. There was the starting point of earnings turning around. And then later on interest rates came off. And let's just double check. Let's add in CPI. Let's put in our CPI. So yeah, we saw inflation explode up to nearly double-digit figures in America, but then it really started coming off, so it was assisted massively at that point. Now, look, at this point here, I'll be honest, I would have been a bit nervous jumping straight in at that point, because although I'm seeing the earnings turning around, we certainly weren't seeing inflation and interest rates coming down at that point. But nonetheless, just to prove to you what earnings does to shares, let's go and have a look at that point. So where was the date? 22nd of January 2021. Sorry, it's a bit difficult to see, but 22 January 2021. All right, so let's do it. Let's go back to 22 January. I was trying to line it up before. There we are, 22 January. Same deal. Let's just look at let's say the top 30 here. All right, so here are the top 30. These are all the stocks in America. rank with fundamental and technical analysis. What I've done on this one here is I've ranked them with the strongest financials, relative safety. All right, so these are companies with the best financials. And let's do this. Let's quick test all 30. All right, so let's run it through until the current date. All right, so here, wow, look at that one, 1,260%. It went up in video, $13 to $186. Pretty decent, right? There it is. It was all there in VectorVest. And so anyway, the average return across those stocks was 78%. And over here, let's change it to, now, let's do the SPY, for example. It tracks S&P 500. All right, so this pretty much kept up with the S&P 500, 78 versus 73. And we know that the S&P 500 has rocketed away. You often get investors saying, well, it was great to see the S&P 500, but who was really going to be able to track that? Maybe I would have been able to do it with an ETF, but I'm a little bit concerned. Oh, but how exactly do you do it? Well, taking the top 30 here, look at that, 78%. Okay, so that's the macro view of the economy. Let's drill in. Let's have a look under views, same as what we did with Australia. Let's scroll it down a bit. All right, so here we go. We are coming up here. So we're seeing earnings are rising, yes. We're seeing inflation, same as in Australia, just peaking up slightly, but it's on 0.91, so it's not far to go until it gets to 1. All right, so it's sort of neither here nor there, but it is slightly on the rising side of things. And interest rates definitely are falling. So we get rising earnings, rising interest rates, rising inflation. And so we are in a case one bull market begins. Now, I know a few of you might be saying, but really? The market's been rallying since about April. Surely it's going to come off. It's not to say that there won't be breathers at some point during the bull market, but we're still in a bull market. Let me go and show you the earnings for the S&P 500. And then I'll show it to you on the ASX 200. All right, so I'm going to go to viewers, watch list viewer in VectorVest. And so we've got this wonderful watch list viewer. And in here, I can come and find the S&P 500. Here we go, S&P 500. I've made a few derivations of it for my own investing. All right, so here's the S&P 500. All right, so at the moment, give or take, so there's 503. We're just rebalancing slightly here. But there it is, S&P 500. Right click down the bottom. I'm going to view the average of the S&P 500. Here it is in America. You can see, look at that. Look at the explosive breakout since April. Up it goes. Let's have a look. Was this justified via company earnings? EPS. Now this is a 12-month leading forecast on earnings. It'll take into account historic, current, and then builds in forecasted earnings. Very, very powerful. I believe that this indicator on its own is worth a VectorVest subscription price, because here it gave me absolute confidence that the S&P 500 was going to continue to track higher. Look at the earnings. When you look at it here in hindsight, it's as plain as day to see. There are the earnings. Up they go. Sure, there's a setback here. Oh no, the world has come to an end. There's been a crash in the share market. But the smart investors just looked at this and said, yeah, it's a little bit of a blip. All right, we might wait a bit. Oh, earnings are picking up again. Away we go again. So, it takes away that sort of that fear. New investors, this is the end of the world when these type of scenarios take place. To the informed, it becomes an amazing buying and opportunity. All right, and so you can become informed. No doubt many of you in attendance today are VectorVest subscribers, and that opportunity there, you were licking your lips with anticipation for the next wave up when you saw the earnings coming up. All right, so when you look at it like this, it's very humbling, isn't it? You look at this and go, well, what was I worried about? What was I worried about over the last 15 years? The earnings are going up. Well, let's go back to the global financial crisis. Let's see what happened here. You can see I've drawn in a few lines. This is my account over here, and so you can see that's where the start of the earnings were declining. And so therefore, that's where you started to see a fall. I'll just clear the drawings here and just zoom it in. So the last time we had a really nasty downgrade in earnings was the global financial crisis. And here it became very apparent at that point there. Whoa, be careful. This is falling away rapidly. Even prior to that, you were seeing, this. And so here you might have said, look, that's enough. I'm out. Earnings are falling. I'll wait. I'll wait. You have to be a bit patient, and then game on. That's where it begins again. So you might have got out around about here. Saved yourself a lot of pain. Jump back in when the earnings started to pick up. And that was one of the most explosive rallies ever in the United States. And this was life-changing money for many of our subscribers and many investors out there, because earnings came back with a vengeance. A lot of money got printed. A lot of growth took place. Huge stimulus took place. And the market boomed on. All right, so that's the story of the S&P 500 and the importance of earnings. Let's do the same exercise for Australia. Let's close out of here. And let's jump into Australia. Here we go for Australia. Same deal. I'm going to go to the watch lists. Same folder again. S&P. All right. S&P ASX. You might have seen a folder up there that said Host Plus. Just out of interest, I use Host Plus Choice Plus, I think it's called. And that is where I do my ASX investing. So ASX 200. Here we go. So here's ASX 200 there. Okay. And so here we go. So I run my own self-managed super fund. I've got a mix of ETFs and stocks at the moment. So just to hopefully give you some confidence, I don't just train at VectorVest. I apply what I apply to what I do in training. Okay, so let's move it across. Sorry, I just see my camera here. I'll just adjust it there. Well, it's just on the tripod's just moved. I'm sorry about the background there. I've just perfected it. All right, so that said, let's right-click, view the watch list average down the bottom. Let's do the same exercise. Here we go. Here's the ASX 200. Let's pull it back a tad. All right. So let's see. How is Australia stacked up? Well, the last 4 years and 5 months, earnings look pretty good. Probably not as explosive as America, but very decent. Let's see, the last 10 years. Here we go. Ooh, this was actually quite a solid rise up here in terms of the gradient. When you look at it, it's actually probably on par, if not better, in pockets of time on to the S&P 500. But let's look. All right, so a little bit lumpy here. This was a period here where you wanted to be a little bit careful. And so the earnings were falling and the share market went nowhere. It kind of fell and then came back up. So it didn't actually fall as badly as I thought, but it was just treading water. All right, and then after that, up come the earnings. Beautiful time period here to invest from 2017 through to about 2020. We saw a very good rise in the share market, and then COVID hit. So this was COVID. And what was interesting is that a lot of the ASX 200 stocks took their lead from what was happening in America long before the earnings flowed through into Australia. So that's why I like to look at America as well. And so then eventually that also caught up. The earnings fell away. So it was a bit of a lag on those earnings. So pay attention to what happens in America. It often gives you an early warning. Here, despite earnings falling away, a couple of our big blue chip investments, just self-managed super funds and hedge funds and the like, just said, oh, well, we're just going to buy in regardless. And so it's not often I'll see where earnings are falling away, but price continues to rise. But nonetheless, once earnings picked up again, you knew it was game on. So around about here, you see the earnings picking up. And so you know that on average, if the earnings continue to hold up, a little bit of a slump there, but away it went and it rocketed up. Okay. But if I go back to 2008, the global financial crisis, so let's zoom in there to show you what happened on the earnings. And you can see here, huge collapse in the earnings. I might just have to recalibrate it quickly here. We'll just zoom it in for a second, just to let it recalculate. So you can see big fall away in the earnings. It really fell away sharply. You know, when you look at it like this, it doesn't look like much, but at the time you could see it was relentless. And so, you know, around about here, you might have said, whoa, that's enough. That's enough for me. I can see those earnings falling away. I need to be careful. And so we waited for the earnings to finish bottoming out. So they sort of bottomed out here. They recovered, kind of went sideways with a trend to the downside. So you just had to be patient. And then you started to see that turnaround starting to pick up. So Australia really sort of started going around about here. You might have missed out on some of this as you're waiting for the earnings, but here you started to see those earnings, 217 the earnings started to rocket up, and away it went. Okay, so the importance of making sure that you're also checking in on the macro picture. Are earnings rising? You know that you've got a good chance of making money in the market. Is inflation ideally falling? Are interest rates falling? So, ideally you want to be in any one of the bull markets. And so the worst case scenario would be rising in terms of bull market, rising earnings. You need earnings. Earnings need to be rising for a bull market. If earnings are falling, you're not in a bull market. But you can have inflation and interest rates rising. Now that will typically signify the end of that bull market. It's coming to an end because inflation continuing to rise and interest rates continuing to rise will invariably eat into the earnings. And eventually at that point, the earnings start to fall. Why? Because inflation and interest rates start eroding into earnings. And that's why if you can have a market where inflation is falling and interest rates are falling, it plays right into your hands to get into a bull market. All right, so that's why I'm watching the earnings at all times. This is absolute key. Earnings need to be rising, and then if I can get either one or two of these are falling, then it's game on. And so, even if I was in this case 3, where earnings are rising, inflation is falling, but interest rates start coming up, although it really happens, I'm still in a bull market. So it's a good time to consider being in the market. And again, I can't give you personal advice, but what I can show you is if you come in and you log into VectorVest every day, you can look at some of our trading systems. And so you can see over the last year, for example, you can see how these have been performing. So this gives me some ideas. All right, while the market is in a bull market, I could come in here and get some ideas. VectorVest fastest growing stocks. Click on the trading system details. It loads up, and I have a bit of a look to get some ideas. All right, so that's how it's performing. My goodness, it's done really well. You can see all the key metrics. Scroll down a bit more, and I like to look at the top performers. So I'll get some ideas. SKS, 360. 360 is the ticker code, Life 360. Catapult, CAT, GDG. So here are some superb stocks to consider in terms of when the bull market's thriving. I can go to Stock Viewer. I can load up the current date. So let's bring it through into the current date to get some more ideas. Here we go. And so I can come in and have a look at these. So are these stocks stacking up? Are their earnings going up? Yep. Rising earnings, rising share prices. Make sure that inflation, interest rates in the economy are falling. It's game on, right? You're getting the macro picture in your favor. You're getting the micro picture with the individual stocks with some of the best fundamentals and technicals. And you can come along, of course, get some superb ideas at your fingertips each and every day. So I hope you got a lot out of it. And thanks again for coming along. As soon as this is finished, it'll be archived on YouTube. Please feel free to share with friends and family, work colleagues, whoever may get some value out of it. Thanks for your attention today. Hope you got a lot out of it, and we'll chat to you same time, same place next week. Bye for now.